Hey everybody, Larry Berman here. Another crazy week for markets. And as we've talked about in the last few weeks, we saw a potential of a bottom forming. Our tactical indicators were extremely oversold. And when you get into that kind of an environment, the market is ripe for a turn and a squeeze. And so, a week ago Friday, we talked about the Fed leaking out the beginning of a pause, a reconsideration. The Fed has not pivoted. They're not going to pivot at this week's FOMC. If anything, they'll reiterate their hawkish tone in terms of higher for longer. However, they are going to recognize, because they have to, that the economic data, forward-looking economic data, is turning. The rearview mirror data stuff in the mirror. Oh, who's that? Oh, there's my bull friend. The rearview mirror stuff is basically telling us that they've already done a lot and it hasn't got into markets, and it's starting to get into markets. And eventually, this guy comes back. So we've got this counter trend rally, but the bear is still, in charge here. So I don't think we want to lose sight of that reality and on where we are in the cycle. The Fed easing here is going to be 2024. I'd be surprised if they were able to ease next year. I think inflation pressures are going to come down. We got actually the PCE numbers that came out this week, they just weren't higher or worse than expected, which the last couple inflation prints have been. So there was some relief there. But wow, what a move in the market on, from overnight Thursday and the bad news that we got from Amazon. And, I thought when Apple's earnings report came out, it was actually pretty darn good. And of course, Friday, Apple was able to lead us out of this. So, let's have a look into the internals in the market and see what we learned this week. Okay, so our snapshot in the market here, looking at the breadth of the market, the advanced decline line, percentage of stocks above their moving averages. So we could see we got a 90% update here in terms of breadth on the S&P. Very powerful breadth thrusts. The problem is we're now getting closer to key resistance levels. And for us, we think the 4,000 level on the S&P 500 is pretty big, and we'll show you that in a second. As we look into, is the market overbought or anything even close to that yet? No, we're not there yet. So the market has some more room to go here through the seasonal strong periods of November and December. How high do we get? That's the big question. But we'll have a look at that in a minute. So let's do this. Let's do an SPX index. And let's have a look at our Fibonacci retracement. So Fibonacci is not, the sole determination of where support and resistance is. But if we take the big retracement, the first big resistance level is around 38.2, 4,000. If we take the same retracement from the recent peak and run it down, the 61.8 runs into 4,000 as well. If we project out a little bit here, this falling 200-day average the next couple of weeks comes down to 4,000. And of course, the last move hit that 200-day and failed. Could we get higher? We could. What needs to happen for us to get higher? Well, the Fed needs to be, Powell needs to be brilliant this week to get the market to squeeze a whole lot higher here. I think there's room for it. When we look at the internals in terms of what's moving the market, we look at the equal weight S&P compared to the market cap weighted S&P. An equal weight S&P takes every one of those 500 stocks and says it's worth 0.2% versus the SPY that has Apple at almost 7% now. And now Amazon's not what it used to be. Certainly Meta's not what it used to be in terms of the big names. Google's not what it used to be. Microsoft's come down, is not what it used to be, but still, pretty high. And if you take those mega cap names, and here's another couple of ETFs we look at to see where the strength is in the leadership. MGV is mega cap value versus MGK, which is mega cap growth. And you can see, just put this on a year-to-date basis, that mega cap value is outperforming mega cap growth by 35%. So clearly where the weakness is and where the strength is definitely between growth and value. You get a little bit of that when you look at RSP relative to SPY. You get a lot of it when you look at value next to growth. Now, some very smart portfolio managers, when you look at MGV and look at what's in it and what's moving it, there's a lot of stocks in here that are not cheap. So when you think value, you think Warren Buffett, good value, cheap. And there's many of them, but not a lot of them. And so again, what's moving the market? When we look at the relative, cost PE between them, you do see on average that this group is trading at around 12 or 13 times forward earnings, where the mega cap growth is trading at 20, 25 times earnings. So when you kind of look at it from this perspective, and you look at the allocations in terms of sectors and multiples, the average PE for the growth names is 28. Now, you can strip out some of the extremes and come down to like 25. When you look at MGV, again, you can strip out some of the higher ones and you come down to 12 or 13. So, and those are trailing, not forward. So on a forward basis, the value side of the market is pretty decent. Now, those value names at full value ever only get to 14 or 15 times. So it's not like there's a massive upside here, but it does show you what's going on under the hood. And there's a huge part of the market that does show a lot of value or relative value. And then there's a huge part of the market that actually says it's still pretty expensive. So that's kind of what's going on under the hood here. And when we look at the bull and bear pick of the week, where do we look at these value names where they're expensive? And to me, it's the energy names. You go back to the peak in energy in 2014 and the kind of fall off there, and you say, where are we now? And you say risk return. Probably not a lot of upside to these names. So again, I'm a little bit less interested right now in some of these value plays, specifically in the energy play space. And for the coupon clippers out there, large cap tech, dividend flavored covered call. This is kind of interesting. I love Intel here. It had a great move off earnings. I think it's a compelling dividend play at around 5%. It probably over the next 5 years is a double. There's not going to be a lot within good dividend paying large cap tech names that have that principle to them. So that's kind of what's on my radar this week, and we look for a very interesting week with the FOMC next week. Have a great one, everyone.